I think a dominant market theme is definitely the Fed, right? So I think the minutes from the October meeting proved pretty convincingly that they're going to lift off in December. Proof positive for me was the fact that the debate has really shifted from the starting point to the path and the trajectory of the rates. And, you know, insofar as the upshot for equities, I'd expect them to be actually relatively mild. Is this going to be a surprise for markets? Arguably not, given that even fixed income markets, which have been the most critical, or sorry, the most skeptical of the skeptics, have finally come around. You have the 2-year note up 30 basis points in the last month, and Fed funds futures are pricing in about 70%. So I think, you know, the surprise factor is relatively limited here.
I would say bricks plus clicks. So really people getting access to deals on their phones, the use of mobile. And this shopping season should be a little bit easier. In-stock levels at names like Walmart and others will be higher.
We don't think that it's going to put, you know, the business suit or the core denim out of business by any means. But again, I think what you have here is more awareness of health and wellness. I think, like I was saying before, I think technology is a whole nother leg of this, and people, you know, more aware of their health, more aware of some of the statistics. I think that's going to create even more demand towards some of the more specialized side of it, you know, whether it's Pilates or whether it's running versus basketball. And I do think you do have more of a mobile workforce, which is contributing to it as well. But, you know, the call here is not that it puts core apparel out of business, but I think it can be a continued shift toward this lifestyle inflection.
Education, technology, entrepreneurship, those are important drivers of productivity, but we know that prompt drivers of productivity are investment, CapEx, and trade. Those look likely to stay slow, particularly U.S. exports through 2016, in part because of the dollar. So, look, I think we've all lowered our standards as to what constitutes good productivity and good economic growth. The U.S. economy probably does a little bit better than 2% GDP growth. Labor market continues to tighten, which is why we think the Fed does hike. But there are profit pressures, there are revenue pressures at the S&P that persist.
Are we looking at the trough, though, in earnings? Are things going to improve from here? Because that's what the drumbeat I've been hearing over the last week or two.
Yes, we are going to exit this 2-quarter profit recession. Q2, Q3, S&P earnings down slightly on a year-on-year basis. We've had down revenues, about 4% will be likely the case for full 2015. But we're going to exit this profit recession with a whimper. I don't think earnings growth is any better than 5% next year.